Thanks for joining us and checking out this month's market update. Harry, how did the markets do in May?
Well, May started off really rocky like the previous 4 months, but actually by the end of May we actually had a big bounce and we ended up relatively flat. So the US market, the S&P was actually dead flat. The NASDAQ definitely still was having problems. It was down about 2%. The Canadian market was relatively flat too for May, which at this point is kind of a win for all of us, getting flat. Europe slightly positive, Asia slightly positive, and China also was slightly positive. So overall, some better news in 2022 than what we've been getting up to this point in time. David, the American Association of Individual Investors Sentiment Survey is currently at its lowest reading in 30 years. Is the current level of pessimism in the markets justified?
I think to a degree, probably it is. Like, we're all aware of the issues of the day. Obviously, inflation's a major concern and focus. Everyone's talking about it, everyone's feeling it. And then obviously the war in Ukraine is another sort of threat to the markets, and it's certainly an inflationary pressure. But I think at this point in the year now, we've seen a lot of repricing in the markets, especially in the more speculative corners of the market. Everyone is keenly aware that interest rates are rising. The market, to a large degree, has priced this in stocks and in bonds. Now, we're kind of expecting interest rates to reach around 3% in the US and Canada by year's end. The key thing will be obviously inflation readings. If inflation continues to be stubborn and doesn't roll over at all, that rate may need to go a little bit farther. So the pessimism is probably a little bit justified, but we're seeing that probably things could get a little bit better. It seems like inflation might be at its peak. Now, in terms of that, Harry, it seems like it could be at its peak, and we're starting to see some readings of that, but it seems to be all that anything, inflation is all that everyone's talking about right now. It's top of mind. I actually saw a billboard driving through Maple Ridge the other day at the liquor store, advertising some inflation booster drink, or inflation buster drink rather. But has inflation peaked? What do you think?
I mean, no one really knows, but I mean, a lot of the indication is that it has. I mean, we had 7 consecutive rising months, and May was the first time it actually decreased. So first time we actually started heading in the other direction, which definitely is a great sign. We've also seen a lot of different products, cars, they've been rising with inflation. Suddenly they've come down a bit. Lumber has dropped immensely. It was going crazy. So quite a few of the resources that we've seen have started to turn the corner. We still have one very stubborn resource that hasn't sort of turned that corner, and that's basically oil. And a lot of that, David, is just dealing with the Ukraine-Russia war, and all the supply that normally would help supply the world is just taken off the table right now. And so definitely that's been our one stubborn inflationary area is oil. But again, most of what we're seeing is it looks like it's peaked and is turning the corner in most areas, unfortunately, except for the oil. And, we're going to keep an eye on those things, but the one thing that I think is really going to be a good indication is wage inflation. And we've seen a steady case of wage inflation as well, and it looks like that as well is sort of peaking and ready to turn the corner. So if that's the case, then definitely things should start stabilizing out. But, with that in mind, David, what are the opportunities out there right now?
Well, I think there's definitely areas of the market that have been really, really sold off, and I guess the jury may still be out on whether the bottom's in on some of these tech stocks like, Apple, Microsoft, Amazon, all these so-called FANG stocks that have led the market and make up massive weights in the US market, have seen pretty pronounced drops this year. But as long as their earnings keeps up, we may see a recovery in some of those big names, which tend to lead the market, right? So that's what we're waiting to see. and portfolio managers do find some opportunities in certain sectors that have really been sold off. Some of the consumer discretionary products, things that people don't need but maybe more of a want. Some of those stocks have really fallen this year and could be good buying opportunities. And just generally, stocks and bonds probably are going to do better going forward than they have for the last 6 months, because their performance relative to cash has been historically poor. So relative to history, cash has outperformed stocks so significantly that so far this year, only the 2008-2009 financial crisis period saw cash continue to outperform going forward from today's levels. So as long as we don't have that type of environment, stocks should, on a relative basis, start to perform a bit better to cash. The same thing has been true of bonds. We haven't seen bonds be outperformed by cash to this extent that we have in 2022 since 1994. And so at this level, history has shown that probably bonds are going to start to perform a lot better relative to cash than they have so far this year too. We've seen similar periods in 1984, 1987, and 1990 at this level of outperformance for cash. It kind of stopped and bonds started to do better. So obviously the major thing, it continues to be inflation. As long as we start to see inflation come down, it doesn't have to change overnight, but as long as it starts heading in the right direction, which we think it should, because we have had quite a few interest rate hikes now, it takes time for those to work their way into the market and have an actual effect. It's a little latent, it could take months, but as long as we start to see that trend change, that should help stabilize markets going forward.
As always, if you have any questions, please don't hesitate to give David and I a call. We're happy to update your plan, but I really stress I am happy with the portfolios that we have and the valuations inside your portfolios. What I'm not happy with is the short-term performance that we've been through, but this is again what I call an event volatility. It's not an economic one, it's an event that is causing economic impact. So I like the holdings we have, and patience is definitely going to reward us all. But again, if you need anything, don't hesitate to give David and I a call. Take care.